Here at the time of recording this video, markets are down a lot. Take a listen to what Tom Lee just said about stocks.
Incredible just to see how quickly the market narrative has changed from expecting a rate cut in June now to some economists saying perhaps not at all this year. You've been in the seat that Powell is in, different country, India, but still I'm curious how you think he navigates this complicated scenario that we're in, which is hotter economy with the inflation remaining much higher than expected and at the same time rates also staying higher, the impact that could have on consumers.
Yes, clearly what's happened is we've had three strong readings of inflation. One you can dismiss, certainly the January one, but the next two basically suggest inflation is not coming down. In fact, it's going up. And if you look at the measure that the Fed has looked at most closely, which is the super core measure of inflation, taking out housing, it's gone up at an 8.2% rate over the last 3 months. So this is something to worry about. Is inflation coming down steadily as it seemed at the end of last year, or is it having a new set of legs and moving up? So my sense is, they're going to do what they did, which is watch and wait. But, you heard, the New York Fed president talking for the first time about potentially rate hikes. I think that's still some ways away, serious talk about that. But clearly, the kind of rate cuts that were expected are off the table. Certainly in the next meeting, they have no more news on inflation or the labor markets. And it's likely they will continue pausing. But how long they will pause is now very much in question.
Tom, Professor Rajan mentioned John Williams, New York Fed president, who did just mentioned rate hikes, but he did said that's not his base case. But even the fact that he mentioned it, you saw the 2-year move to around 4.99%, which is a high for this year. You still have this notion that stocks can continue to outperform if rates stay high. How long do you think that theory will last?
Well, I think it's going to be valid as long as one of several things happens. One is that as long as the economy remains resilient and robust, and so far earnings have actually been coming in quite good. I mean, we're only sort of at the start of earnings season, but already Q1 looks good. And I think the second is that inflation, I think inflation really has a bifurcation taking place because even as the professor said, it's super core. The reason Supercore is annualizing at 8% is auto insurance. If you took auto insurance out of Supercore, the long-term average is around 2.7, and it's actually annualizing at around 2.7% right now. So the biggest driver of inflation are the two stubborn components of auto insurance and shelter. So I don't know if Williams really wants to be raising interest rates or hiking just because auto insurance rates are high. And I think the third thing to keep in mind is that we don't really need the Fed to make, 3 cuts. I think the one risk to markets would be that the inflation is accelerating to the point where the Fed has to hike and therefore really weaken the economy. I think that's still very much a tail scenario, but that's the one, of course, that would unsettle markets the most.
Professor Rajan, how critical is China's recovery to global economic performance?
Well, it certainly is very important, right? China has been the engine of global growth for a long time, pre-pandemic. But I think it's also important for, the reflationary forces we're seeing. I mean, if you look at commodity prices, they were largely dead in the water for the last year because China wasn't performing up to expectations. As Chinese growth news is getting better, you're seeing some commodities perk up. Certainly, you're seeing copper pick up some in recent weeks. So my sense is that the deflationary effects of China, which have been substantial, especially on the goods side, may abate a little bit if Chinese growth picks up. And of course, it will also add to global demand, which is important.
If you guys don't know who Tom Lee is, Tom Lee was the guy that was screaming to buy tech stocks when they were selling off in 2022 as well as 2023. And that proved to be a very good call. And during that moment of time, that was probably the most contrarian call that you're going to hear for a long time, meaning that everyone was bearish and he was the only one that was bullish and one of the only few that was actually correct in being bullish. when everyone else was bearish. See, I am a contrarian by nature. I was also bullish in 2022, at least for most of 2022. Well, I was bullish in the wrong areas. I was bullish on interest rate sensitive names that would ultimately benefit when the Fed stopped raising rates and then subsequently, typically shortly afterwards, they start to cut rates. That call was completely wrong. Should have been in big tech, should have been in your big tech names. But I think that doesn't matter. Who cares about 2022 or 2023 or even up until April 18th of 2024? It's more important what is coming next. And I gotta say, I agree with what a lot of Tom Lee said, but I do think we are in for more pain in the markets. And I do believe that other individual that is in that clip with Tom Lee, he used to be the Jerome Powell of India, makes a really good point that China is starting to recover. We just seen last night China's GDP numbers came in stronger than expected, over 5% GDP growth. I believe it was 5.3%. That is going to have inflationary pressures and consequences on a more global scale. Just America is the largest country in the world, so we're going to feel it more and likely feel it first. And I think that's part of why inflation has been ramping up recently. Now, one of the biggest areas that I do disagree in regards to what Tom Lee just said is the markets are forward-looking. Yes, John Williams just said today that maybe the Fed might need to raise rates, but that's obviously not his base case. But that was the first time Fed officials in about a year have talked about needing to raise rates again. And that could be part of why the markets did poorly today. But the specific reason why I disagree, or point that I disagree with that Tom Lee made, was that the Fed needing to raise rates again is a tail risk. And I think indeed that's a real risk. I think that is a risk that could be coming in the not so distant future. I can envision a scenario, let's say the CPI report that comes out around May 10th. It's usually the 10th, 11th, 12th, something like that, every month, right? If you come in hot in May, you come in hot in June, you're going to be talking about raising rates again. Now, I would also like to point out the NASDAQ has already fallen about 6%, if this math is correct here, from all-time highs. A little bit less than 6%, but round it to 6%. This decline has not happened really because inflation has come in hotter than expected. The markets didn't care about that. The markets didn't care about what the Fed said. You had geopolitical tensions and earnings. Those are the two things that have really started to cause the markets to sell off. So I don't think the markets are pricing in even a chance right now of the Fed needing to raise rates again. Now, in the short term, it's all going to be about earnings. And problem is, markets have done so well in 2024, it really doesn't matter what you get for earnings. You're still likely going to sell off because expectations are way too high. For an example, Netflix came out and beat their subscriber estimates by over 45%. They were only expected to grow subscribers by about 5 million. They grew them by 9.3 million. But they guided down for next quarter about $20 million, which was well under 1%. And what happened? Well, the stock sold off about 5%. They beat on EPS by about 80 cents. They beat on top line revenue by 100 million or so dollars. It didn't matter. I don't even think if Netflix gave you good guidance, the stock would have been green following earnings because the stock had already done so well heading into earnings. And in 2024, really ever since October, November lows, a lot of stocks have doubled up or more. And if you're a stock like that, you're not going to do well on earnings. I actually forecasted this downside for the markets for a while now because expectations were just way too high heading into earnings. What happened? The banks were red, largely. JP Morgan, Citi, couple other banks were pretty red, but your larger banks were pretty red after earnings. But forget the banks. Banks don't even matter in regards to the markets in this conversation. ASML. First high-flying AI stock that has almost doubled from October, November lows. That stock reported, well, not so great numbers, and especially their new orders coming in for their UV products, well, they're not doing so well. Really showing TSMC and Intel and Samsung are slowing down their investments in these high-end chips, or at least the equipment needed to build those chips. So ASML dropped 7% after earnings. I forecasted that. TSMC dropped about 5% after earnings. I forecast that. Netflix dropped about 5% after earnings. I forecasted that as well. And it was simply because these stocks were trading at or near all-time highs. Problem is, all of big tech that has held the markets up in 2024 are trading near all-time highs. It really doesn't matter how good the earnings are. You really have to knock investors' socks off for stocks to do well right now. Because of a couple different reasons. But most notably, I will point out, easy to point out, the 10-year Treasury yield is at 4.6%. I mean, you are down here what looks like about 6 basis points right now. So down a little bit from the trading day. Still, 10-year Treasury yields have rocketed higher. And that's not a bad problem, I guess, for your big tech names that don't need to raise capital or refinance or do any of that. It's not immediately bad, but if stocks start to sell off like a Netflix, let's say Microsoft or Amazon or Google or what have you next week, then 10-year Treasury yields at over 4.5% look a little bit more attractive to money managers to get this risk-free return after stocks have done so well. I mean, you've pulled forward a lot in earnings, especially in your AI stocks like an Nvidia. And all of this is happening not even because, again, inflation. If inflation does go higher, let's say the current pace that we've seen throughout 2024, let's say that happens again for the month of April, which we'll get that report around May 10th. Let's say May is also hot, assuming, the last 4 reports by then are also hot. And that report's going to come out in June. Very soon, you could be talking about raising rates again. The markets price things in ahead of time. If I can confidently sit here and say today, the markets are pricing in a 0% chance of a rate hike throughout all of 2024. If those odds start to go up even a little bit, that's very problematic for stocks, right? And I can sit here and say the markets are not pricing this in at all, because they're not. I mean, take a look at November or December's Fed funds futures contracts, and there's no chance of a hike as of right now, a 0% chance, literally 0.0% chance. 35.3% chance of only one rate cut by December. So the markets are only pricing in one cut by December 18th, 2024. There's a 33.1% chance of 2 cuts and a 14.4% chance of 3 cuts. There's this is crazy to think about. There's a better chance, statistically speaking, according to the markets, of getting 1, 2, 3, 4, 5 rate cuts in 2024 than to get a hike, which is crazy. And 5 rate cuts, there's only a 0.2% chance of that, but that's kind of crazy. Let me just say that again. There is a greater chance of seeing 5 rate cuts in 2024 than 1 rate hike. Considering the last 3 months of super hot inflation data, I mean, Supercore running at over 8% on an annualized basis for the first 3 months of 2024 is insane, okay? It's not even a chance of a rate hike. I mean, I don't know if that's going to happen. I don't know if that's the direction that things are ultimately going to go in the markets, but I think that the odds are a lot higher than the odds we get 5 cuts in 2024. Meaning that stocks may be in for a lot more pain from here. Now, Tom Lee also mentioned in that clip about the economy staying strong, because I think that's important. I think a lot of people get caught up in what the Fed's going to do, when they're going to cut rates, or even if, again, they're going to raise rates again, or caught up in what inflation is doing. But the single most important thing to stocks is the economy. Think about 2022. Stocks sold off not because the Fed was raising rates by itself. The market sold off in 2022 because the Fed was raising rates, because the Fed raising rates historically leads to recessions. That's why stocks sold off, not because the Fed was raising rates. That had nothing to do with it. It was because of that probably puts you into a recession. That recession did not come, at least so far, unless you count the first and second quarter of 2022, which I think we'll look back in the history books and say, yeah, that's technically a recession. 2 quarters of declining GDP. I don't care if the government declares it or not. You were in a slight recession during that time. But the recession ultimately never came, and stocks did well because of it in 2023 and so far in 2024. But if you start to get economic weakness, let me tell you, stocks are going to perform poorly, very poorly. The day that we get a negative retail let me tell you right now, the day that we get a near negative or negative non-farm payroll report on a month-over-month basis, stocks are going to be down like 5% if they're not already in the toilet by then. That's not great. And they'll probably be in the toilet by then. Let's not kid ourselves. Expectations would probably be very low anyways. The Fed might even be cutting rates by then. But yeah, maybe even long before then, the markets would be in the toilets. Either way, I think it ends in the toilets, at least here in the near term. Again, considering with all of this information out there in this video, stocks are trading at all, close to record high valuations. That's kind of insane. Now, as to where this takes the markets, I think you have your 100-day moving average to contend with. Triple Qs are at $422, and that's roughly where your 100-day moving average is. If you do not find support at this 100-day moving average, then you probably pretty quickly can head down to that 200-day moving average around 395 on the triple Qs, and that would be likely due to next week's big tech earnings. And if that happens, you want to find support there. If not, you do have a support at about 390. But if any of these things happen, if inflation comes in hot again, if the Fed starts talking about needing to raise rates again, if we get bad economic data, I mean, all bets are off the table. October, November lows could definitely be in play, and that would be about 340 on the NASDAQ. That would still represent downside from here of, let's say, about 20%. Stocks have already fallen about 6%. So roughly that would be like 26% down on the triple Qs to get back to those October, November lows from the all-time highs. And we're not even talking about the geopolitical drama out there. If that gets worse or something escalates there, that can also be quite problematic. So, I mean, I wish I could sit here and say there's a strong bull case, because historically, when you're bullish, you make more money, right? If you're short markets all the time, you're never going to make money. You're always going to lose money because stocks tend to go up over time. But during moments in time, sometimes it's pretty easy to see when stocks, could be coming down or could be coming down in a large way. And I think this is that moment in time. I can sit here and say really the only bull thesis that we know of right now is earnings are probably going to come in okay. Now, earnings coming in okay or even good when, just for simpler terms, the markets are expecting really good, that's still a disappointment, but it doesn't mean you have to crash. That's the only bull thesis right now, is consumers are spending money, going to drive EPS growth in the S&P 500 this year, and what markets expect also next year. If that thesis gets challenged this earnings season, you could definitely see your October, November lows start to become in play a little bit more. After all, I will tell you, this drop that we have seen over the past, call it week or so, is a lot more aggressive to the downside. It's basically straight down than even what you've seen back here in October, November. And this did turn out to be a 10.5% correction from July through October. So I don't have a crystal ball. I don't know what's going to happen next, but there's just not a strong bull case right now. And That's unfortunate. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.